Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and in the world of investing. I'm Stacy Smith, and I urge that you subscribe or say that you like this podcast on whatever platform you happen to be using. Well, the election is over. We will take a look at the market reaction and what might happen with interest rates. Also, companies are in the midst of reporting their third quarter earnings. We'll talk about something that might surprise you. And have you put money into an ETF? We'll discuss the pluses and the minuses of investing in an exchange traded fund. It is coming up on The Bull, the Bear, and You. With me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks again for joining us. Since the last time we met, a new president has been elected, and the morning after the election, investors seem to really like the fact that Donald Trump was holding the reins once again. Or at least will be holding the reins. And the major market indices shot up to new all-time highs, and it looked like it was going to just keep going up. But that never happens with the markets. By the next day, the market started to give back, and by the end of the week, they had lost a lot of what they had gained. But the key is the market still closed the week higher than when the week began. And while the knee-jerk reaction in the markets was based on the election, reality also started to set in over what was happening in the economy, and once again, what the Fed might do in December. So, Carrie, can you sort all of this out for us?
Sure. If I have 3 hours, I can help you to really understand it, because that's probably what it would take. But let me just summarize. I'm not surprised at all that the market went up right after the election, because Trump is a pro-business guy. He's talked about tax cuts, all things people like to hear. I think then what happened is the party was over and the hangover set in, because it's not that easy. And when you look at the policies will work as long as they work, meaning you have to have growth. So I think the market is really second guessing the ability for these policies to stimulate that growth, which means that the consequence would be our deficit going up even more. And, we've talked about this on prior shows, that no one's really talking about the deficit, but the market is clearly concerned. And when I say the market, I'm talking about the bond market in this case, because we have seen interest rates, longer term interest rates, actually go up since the election. And there are three reasons why that happens. It either happens because you think there's going to be growth, or the Fed's going to, you think you're going to have growth, or the deficit is going up at a point at which we're getting concerned that we're actually going to be able to sell our treasuries without interest rates going up. So I think that, in my opinion, that's the scenario that's starting to play out a little bit. So when we get to what the Fed is potentially going to do, I'm not exactly sure. I mean, he's already started to pull back some of his verbiage about, reducing rates, and the data that's been coming out really is mixed. We have inflation that we're not quite sure if it's under control yet. We have jobs that, it's 50-50. Is the job market declining or is it stable? So at this point, I think we need to see some more data to really have clarity on where he's going. The hard thing is that when you go against what expectations are, it can lead to some turmoil in the market. So I'm inclined to say he'll reduce, but I'm not quite sure that that's the right thing at the moment.
Interesting things happening, though, that the yield curve is starting to get more normalized. Lower interest rates on the short end, higher interest rates on the long end. That is good for savers and conservative savers. And I think that potentially what we have is an economy that's going to maybe inflate ourselves out of this deficit problem. But nonetheless, as Carrie said, we've got all these inflationary policies that are laid out there that might happen if Congress lets them next year. And that's a wild card also. All this stuff has to get through Congress sooner or later. And I'm not sure Congress is going to roll over and let Donald Trump do whatever he wants.
I think we always have volatility in and around elections, regardless of who would have won or whatnot. And Donald Trump won, and he won probably more decisively than the market initially thought. And so you had a bit of, markets like certainty. So you had a bit of a cloud over who was going to win, really kind of dissipate. And so the markets they shut up because of that. And they shut up again, I think, also because of what Kerry said. He's regulations might be rolled back. He's more pro-business. He's going to keep taxes low. That the market liked that at first, but then the market took a reprieve based on at least where I think inflation is going to be headed. I mean, I've kind of long been of the ilk that inflation is going to remain a little bit higher for longer, and I think the market has come around to that realization as well. If you would have looked just 3 months ago or so, the market was expecting the Federal Reserve to cut interest rates 7 or 8 times, I think, in 2025. That's down to about 4. So one of the reasons why, as Kerry mentioned, interest rates are staying higher on the back end of the curve is because of that inflation number there. And the second reason I think the markets have come down is simply because stocks are expensive. I mean, we are trading at a PE multiple, a price to earnings ratio of 24 times right now. The 25-year average of the S&P 500 is 17. That is a big difference there in terms of valuations. And again, the components as to why that difference is there. Yet tech is a much bigger component of the S&P 500 now than it was 20 years ago or so. But make no mistake about it, stocks just aren't cheap, and I think the market is somewhat realizing that right now.
All right, I'll be the cleanup batter here. I don't think either candidate ran on how they were going to fix the deficit, but they teased out if you could read through all of the verbiage of each embattling presidential wannabe, one was going to try to grow their way out, and the other was going to try to tax their way out of, the imbalance, we'll just say, between what the government spends and what it takes in. So the growth guy won, and I think it's key that right now, as of Monday morning, November 18th, we don't know who is going to be the Treasury Secretary. And that's big because they have to work with the Fed to enable what the president needs to have happen, right? And Congress, of course, and the Senate. But those two positions, they meet often and they have to coordinate. So it's a very important pick. We'll see what happens there. The fly in the ointment in this whole kind of economy thing and government intervention is this. Most of the lessons that the economists that are around today are looking at are the 1970s. And the world could not be more different. We have shrinking populations, not growing populations, and that's worldwide. We have globalization that's already happened, and a lot of countries are trying to reshore a lot of their industries. So that is the opposite of productivity and lower prices. So it's a tough world out there, and I don't think looking to the 70s and saying this is what we need to do because it worked then is going to happen or should happen. I think we need to think long and hard about this, but we'll see what happens.
All right, let me throw out a couple of things here. One, and this is, we sort of talked about this before, and it's a conundrum to me, is that we got strong retail sales that came out last week. The economy seems to be going extremely well, but then we get this fear factor, I guess, just based on the fact that the Fed may not lower inflation, so that keeps the market down. I like your comment, Michael, about the fact that stocks are basically overpriced. But let me throw this one out also, and this goes back to the new administration, and none of you used the word that I can remember hearing you use the word tariffs, and that's the government regulations that we're talking about here. The Eurozone reported on Monday that its trade surplus rose again in the number of exports to the United States, which means, of course, our trade deficit keeps going down. If there are, and so let me make this a 2-point question. Is that necessarily a good thing or a bad thing for the United States with importing more than it exports? And then second, if there are tariffs are imposed, what kind of an impact will that have on the trade deficit, and then, i.e., on companies that you might invest in? That's a big question, I know.
Let me start with back in the 70s, as Kim astutely pointed out, we had a different world. We manufactured a lot of things here. Since then, we have exported our manufacturing and the jobs that go with it. And now, in the last administration and the administration, Trump's first administration and the current one, the goal has been to onshore it like the rest of the world is doing. Our problem is we don't have the people to do the work. And it's going to be interesting how they do that. Now, technology will play a huge role in that, as with AI and robots and whatever. Kim can talk about that. She knows far more about it than I do. But technology will alleviate that to some degree. But we're onshoring it, and I suspect that's going to be more expensive. And but the world's doing that, and I don't see it being a political issue. It is a political issue, but it's not a domestic issue.
But is onshoring necessarily a tariff?
Well, tariffs are going to create it because they're going to make Chinese and whoever else's product so expensive that we actually might be able to do it cheaper here after tariffs, but that's artificial.
Tariffs are kind of crazy things, right? They actually used to fund the federal government. And, the Trump administration is digging up, like if you think I'm upset about economists talking about the 1970s, I'm pretty upset that we're going to try to revert to like 1885 as a template for how to run our government and our economy. Now, that being said, and what am I saying? I think what Trump has tossed out there is, why would we have income taxes on people if we could tax goods coming into the country and fund our government that way, because that's the way we did it in, 1895, right? I think I'm right there, right? Okay. So while I think tariffs worldwide have shown in his first administration to be very unfair to the U.S., and that grew out of the 40s and 50s, whenever what we now know as Europe was a developing country or a developing region and had to rebuild. But we've let a lot of those tariffs lie there. Now, I think that he would like to rejigger that. I'm all for that. Let's do it. Let's make it more of a fair playing ground. But I don't believe that anyone really thinks that we're going to go to pretty much a VAT tax through tariffs and have zero income taxes. But, weirder things have happened.
So I think that, this conversation is fascinating, because I think we're giving the president way too much credit over what he can control. And yes, policy matters and these things matter, but at the end of the day, you can't control how corporations set prices, and you absolutely cannot control how people spend their money. This economy is 70% driven by the consumer, and that's one thing that you can't control. So, I get it that these are all on the surface, pro-growth, right? You want to create more jobs here in the U.S. Great article in the Wall Street Journal in 1906 about how protectionism against Latin America, because that was who we were trading with and working with at the time, was inflationary. So when you look at all these things we've talked about, the fact that we don't have the people, we don't have the people to even do these jobs, you really have to wonder, again, kind of taking this conversation full circle to, we see interest rates on the longer end going up. Yes, the curve is normalizing, but why? Is it normalizing because a lot of these things that we're talking about, right, even down to, and hey, I'm a supporter, I don't want to eat pesticides either, but you look at what that does to the price of food. So, right now there are options, and you just wonder if some of these policies may create more inflation, and that's why we're getting these higher yields? Or is it that these are actually pro-growth policies that will stimulate growth? Those are the things we're going to be watching in the upcoming months.
Stacey, I think you asked, is importing goods bad or not in our best interest? And I don't think that it is bad at all. I mean, we're a globalized economy now, and each country specializes in what they are most productive in, what they're the best at. Overall, we're not the best and the lowest cost producer of X, Y, or Z. 70% of our economy is service oriented. We excel at a lot of different service oriented business. That's where we can add value. China, Vietnam, India, etc. As of now, they accelerate at manufacturing or producing trinkets, goods and services and whatnot. And that's really what, over the past 30, 40 years has helped keep inflation very, very low as, other more and more economies got introduced into the global economy through NATO, etc. So I don't think we're not upending that by any stretch of the imagination. I think a lot of this rhetoric is just really rhetoric, and it never really comes to fruition here. But again, I look at any sort of tariffs as a one-time tax to citizens and people, until you look for alternative goods and services elsewhere that you could find. But overall, I don't think it's, the fact that we import more than we export is really a bad thing at all.
Okay, and I have a feeling that this is a conversation we'll be continuing over the next year or so when we see what policies are absolutely proposed and which ones are enacted. Let's move on a little bit here. Corporations have been reporting their third quarter earnings and how they think they're going to do down the road. So, Kim, you love the earnings season. You always go out shopping during the earnings season, I think. So how well have the companies been doing? And a major market mover is going to be reporting this week as well.
Oh, yes, of course. The sun that we all revolve around, NVIDIA, will be reporting, I think it's Wednesday afternoon after the close of the market. So that will see if, we're going to have a frown or we're going to turn that frown upside down. We don't know which way it's going to go. So your original question is this: how is third quarter earnings? Third quarter earnings are largely as expected, and just a little bit more, which is exactly how companies want to engineer a good earnings season. Now, I think looking forward, though, there's a lot of downward revision to most companies' guidelines for the next quarter, the fourth quarter. There was, of course, the election and falling rates, maybe raising rates, and I think the CFOs and their boards are trying to present, as they always do, earnings that can be stepped over, not hurdled over. So they're trying to accurately reflect business. It does feel like there's a business slowdown in some areas. And this is interesting, we're seeing a lot more high-level bankruptcies. And some of these are sort of self-inflicted, and I'm talking about the Spirit Air bankruptcy. The DOJ did not let JetBlue buy Spirit Air, thinking that it would impact people's the cost of a ticket. Well, they're still going to be impacted because it looks like Spirit Air is going to go away now. But there's also other, especially retail-oriented names that seem to be going through bankruptcy. And I think what this is really reflecting is not necessarily, TGI Fridays is one. There's some smaller restaurant chains that are going out of business as well. And this is really sort of the debt clearing that happens at the end of an excessive time period, which I would say 2010 through 2023 has probably been a very low interest rate environment where if you're not a great company, you could have borrowed enough to keep yourself going. And having higher interest rates now for the couple of years that we've had has finally put a stake in the heart of some of these businesses. So I'm not terribly worried, but I do see bankruptcies kind of rising, and it's an interesting phenomenon.
What's interesting about that is, I think, at some point in the not so distant future, you're going to have what's called a wall of maturities coming up, where a lot of corporations are going to need to refinance the debt that they put on back when interest rates were near 0%. So if you're already having bankruptcies now, and your debt profile was pretty favorable, you're going to have a lot more problems in a year or two when you have to refinance that debt, and you're going to be unable to do so at higher levels of interest rates. So I know Europe's supposed to be going through that problem somewhat soon. They're going to have a lot sooner a wall of maturity for their debt, but certainly the smaller companies in the U.S. Is something to be mindful of as we progress into 2025 and eventually into 2026.
Yeah, and I think that's a really interesting point, especially given our previous dialogue about how the yield curve is normalizing, and that we very well may settle into a rate environment that is higher, but yet historically normal. And for some of those companies, it's going to be a challenge. So, earnings season, as Kim said, has been good. But I think that as we look into the future, a few things that we're watching really have to do with debt, which companies are paying down debt versus which companies are not, or adding debt. The other thing that has been interesting to watch has been share repurchase plans. Corporations will buy back their shares, and when they do that, that actually adds to the bottom line because they're taking shares out of circulation. So when you look at PE ratios, it can affect that in a positive way. Well, there are a lot of companies that are at the end of their share repurchase plans, and without seeing those plans renewed or extended, they're really going to have to rely on margins to drive price growth. So given everything that we're talking about, and I know that we'll probably get into a show in a few weeks about what our expectations are going into next year, I think that it would at this point look like, especially given that the companies are kind of trimming their expectations, is that we might not have a market that is as ambitious as it was this year. But tune in a few weeks, and I'm sure we'll cover that.
I'm sure we will. Frank.
And as just to add on, Goldman Sachs in the last couple of weeks projects a 3 to 5% growth rate in the U.S. economy, and I love these words, for the foreseeable future. I don't know what that means, but I think that means for the next few years, although I'm not sure this afternoon's foreseeable. And that being said, if that is an accurate forecast, then bonds at 4.5% and government bonds at 4.5% and corporate bonds at 5% or wherever they are, 5.5%, they look pretty attractive because the risk is totally different. And even though inflation may be a specter, that's a specter for all money, not just bond money. And if we're looking at that growth rate coupled with these PE ratios that Michael was talking about earlier, bonds start looking interesting at these levels, even if the borrowing of the federal government causes rates to rise a little higher. I find it pretty fascinating what's going on, and I think an opportunity is going to be created as a result of all this. So rather than sit and look at what's happening and whether it's good or not, somebody once said our job, all four of our jobs, is to do one thing. Take the facts. This is what's happening. It doesn't matter if you like it. It's what's happening. How do we profit from it?
Yeah. Okay. Well, a lot of people are looking for ETFs for profits, and perhaps to the chagrin of Kim, because you like to pick individual stocks. But the exchange-traded funds have brought in the biggest annual inflow of capital on record, $913 billion so far this year, with about a month to go or so. So, Michael, please give me some insight on investing in these kinds of funds.
Sure. Not sure how in depth we should go, but an ETF, for those who aren't fully aware, it's very similar to a mutual fund. in that it's a vehicle that invests in a basket of stocks or bonds or really whatever that represent a certain category. So you can buy an ETF that tracks technology stocks, small cap value stocks. You can buy one that tracks momentum, one that tracks companies that pay high dividends. I mean, really anything under the sun. And over the past, I don't know, 10 years or so, they have just become sort of the vehicle of choice for investors, retail clients, really anybody. One, because they're cheaper generally than their traditional mutual fund counterparts. And two, they're much more tax efficient than also their mutual fund counterparts. You can trade in and out of them throughout the day, which I think for most investors should be not a huge pro, but you know some people do like to trade intraday. So all in, I mean, the fact that these are so readily available to invest in whatever factor, exposure, market cap, international, emerging market that you want to do, makes it a very, very compelling investment for investors. The one big pro I think that mutual funds have over exchange traded vehicles is maybe to an extent a little bit of a lack of transparency. So an active mutual fund manager, so you pick a star manager who you think is very, very good at picking stocks, they don't have to report what they're owning on a day-to-day basis like an exchange-traded vehicle or fund does. Any exchange-traded fund, I can look up and see what they're holding. On a mutual fund, they report on a lagged basis. So you don't know what they own. There's a level of secrecy to that. So if you really do think a mutual fund manager is worth their salt, worth that expense ratio that you have to pay, then maybe I can make the argument that a mutual fund should be included in your portfolio. But make no mistake about it, given the simplicity of it, given how many ETFs are out there to invest in the way that you want to as an investor, the investing world is really, really gravitating towards that ETF profile more so than the mutual fund landscape.
Okay, so let me just jump on here and clarify some things. I agree with what Michael's saying. The problem is that for the individual investor that does not work with an advisor, ETFs you're not getting any professional management. So you're going to have to make a decision as to which ETF to buy. Should I own a technology specific ETF? Is now a good time? Should I rebalance? It is the most tax efficient way to invest with taxable money. But if you don't know which ones to invest in, and a lot of people do. I don't want to discount the fact that there are a lot of do-it-yourself investors out there that know what they're doing, but there are also a lot that don't. So the problem with actively managed funds where you're getting that professional management is that if you own them in a taxable account, you will get hit with taxes unexpectedly. That lack of transparency leads to a ticking time bomb when it comes to taxes. We are seeing it this year. If you are out there and you own an actively managed growth fund that is in a taxable account, you want to look at it because we are seeing the largest distribution of capital gains than we have seen in recent history. And so for us, for those clients that have it, we're doing everything we can right now to tax loss harvest, to make sure that clients have enough money to pay taxes. Stacey, for our clients, especially our retired clients, their largest expense are taxes. And that's probably for every client. So when you get hit unexpectedly, it doesn't matter. All of a sudden clients don't really, they don't really, focus on like, oh, we've made money. They focus more on we're paying taxes. So sometimes we have to remind clients, like, this is a great thing. We've made money for you, but they don't like paying taxes. So that's a very important part of the job that we provide as advisors.
As the old man, I'm going to tell a story from back in the 70s. I was early in my career. My father was a CPA, and we had a common client. We were all having lunch one day in March or April, and my father announced to me that I cost his client, my client too, a lot of money last year. And I said, how did I do that? He said, this tax bill is really high. So I went to the client and I said to him, I'll tell you what, John, I'll pay the taxes. Give me the profits. I never heard that from those two again. So that, to your point, Carrie, money was made. It was realized in a fund, mutual fund, and because that's their job. As we were saying earlier in this show, the market might be a little pricey. Their job is to protect you to some degree, which means they have to sell when that happens. They have to protect you, realize some profits. When that happens, you pay tax. It's life. I feel badly. Paying taxes, to me, is a good thing, not a bad thing.
Kim, your thoughts?
Well, the cleanup batter here again in this is going to be kind of a downer and kind of a nerd moment. So the issue is this, that if there are too many, and I don't know what number that is, too many ETFs that are just following an index and they get popular, they are going to reinforce the order of whatever that index is, because they're buying, every time you buy something, they buy the market on a market cap weighted proportion. In the old days in which I started, before ETFs, we'll put it that way, most managers of mutual funds were actively picking stocks, and with whatever lens they had, growth, value, momentum, whatever it is, they would look at these stocks and evaluate them and include them or exclude them from their holdings. But with indexes, and especially ETF indexes, it just sort of reinforces the winners win and the losers lose. And that's not necessarily what you really want out of a market. You want people deciding, is this company worth what we're paying for it? And when you're buying an ETF that's an index, you're reinforcing the world order, if you will. Does that make sense? Hopefully it does.
Yes, it does. We have to wrap it up here, but Carrie, very, very quickly here, on the matter of taxes, on the ETFs, you wouldn't pay a tax on that until you sold that ETF. Is that correct?
That is correct. And we use ETFs for our clients and taxable accounts many times. And I think the one thing that we just want to caution people on is that you're not paying taxes, but you're also creating a tax problem. Because at some point, when you do need to sell the fund, you're going to pay taxes. So the best method for managing a portfolio, any kind of portfolio, but especially a portfolio of ETFs, is to do rebalancing along the way. You know, look at different time frames. What we're doing is we're looking for those inflection points in the market where, you know, the market's trading at a high, we might see some headwinds. Okay, let's rebalance. Let's take some of our gains. So in essence, then, for the client, it creates a much smoother tax situation when you're kind of taking taxes over time.
All right, great. Thank you for that explanation. We will continue our look at investing in the economy in future editions. And I ask you once again that if you are watching this program or listening to it, to hit the subscribe or the like button and continue being able to watch and listen to us. But for right now, thanks for joining us, and we'll see you again in about 2 weeks or so. Thanks.